All that we learned in this video so far brings us to the discussion of debits and credits. And the first question we should ask is, what are debits and credits? A debit means that an entry is made on the left side of the ledger. A credit means that an entry is made on the right side of the ledger. Debits and credits are used to increase and decrease the balances within accounts. A person that is new to this topic will usually ask the following question: does a debit increase or decrease an account balance? Does a credit increase or decrease an account balance? And the answer is that it depends on the account type. It's critical to understand that a debit or a credit can both increase or decrease the account balance based on the account type. I promise you that we can make sense of this. And to make sense of it, we'll need to go back to our accounting equation. The accounting equation states, assets equal liabilities plus owner's equity. There are specific rules which dictate based on the account type whether debits and credits represent an increase or a decrease in that account. Let's list these rules. Assets increase with a debit and decrease with a credit. Debits and credits have the opposite effect on liabilities and owner's equity. Liabilities and owner's equity accounts decrease with a debit and increase with a credit. Expenses and losses increase with a debit and decrease with a credit. Revenues and gains decrease with a debit and increase with a credit. Just listing out these rules makes it really hard to understand what is happening and makes it very difficult to remember them. Yet this is critical to understand because all of the financial accounting is based on these principles. But don't worry, we will approach this in a way that will make it much easier to understand. Specifically, in order to provide clarity on how the rules for debits and credits work, we'll introduce a diagram. This diagram is based on our accounting equation. After we go over this diagram, things should make more sense. This diagram lays out a T account below each element of the accounting equation. Each T account, in turn, shows whether debits and credits increase or decrease that type of an account. It shows you the effects of debits and credits on assets, liabilities, and owner's equity. Notice that the T accounts for expenses and revenues are below owner's equity, with an arrow pointing towards it. That is because expenses, losses, revenues, and gains flow into owner's equity. Don't just try to memorize this. As you'll study this diagram, you'll notice that there is a specific logic to it. Specifically, you may notice the following important relationship. The way debits and credits affect different account types is consistent with the specific side of the accounting equation these accounts appear on. Our accounting equation has assets on one side and liabilities and owner's equity on the other. Well, the way that debits and credits affect different account types depends on which side of the accounting equation these accounts are on. In other words, assets, which are on one side of the equation, increase with a debit and decrease with a credit, whereas debits and credits have an opposite effect on liabilities and equity, which are on the other side of the equation. Liabilities and owner's equity accounts decrease with a debit and increase with a credit. As mentioned before, revenues and expenses flow into owner's equity. As such, revenues and gains decrease with a debit and increase with a credit, just like owner's equity. Expenses and losses have the opposite effect. They increase with a debit and decrease with a credit, because they decrease owner's equity. These concepts may seem challenging at first. The only way to get comfortable with this is to get a lot of practice.